So now we will be discussing the examples from the real exam question. Okay, what I have done is that I have extracted the case study line from the different exam questions because if you will see the questions related to the audit risk in the past papers or your exam kit, you will see that 80% question is the same. 80% question is the same. Like the 20% can be a new risk coming up in the exam, but more than 80% is going to be the same. You compare all those questions, we'll be doing that after we have done the theoretical thing. So you will see that there's a lot of similarity between the questions. The same thing is being discussed, being asked again and again within the exam question. So that is why it is important to discuss all those scenarios so that if they are being repeated, you are able to solve that easily. And even if they are not repeated, let's say for instance they are not repeated, even then it will give you the idea that how you will be writing the audit risk thing in the exam. Now the first thing first is that whenever you will be having an audit risk question within the exam, there will be a case study which gives you different information. For example, they are doing the research and development, they have sold some of their property, plant and equipment, they are not performing the bank reconciliation, they're not performing the vendor reconciliation, they have the damage inventory. There will be so many things, and I've already told you that there's a linkage between these, understanding the entity with the risk assessment. What you need to do is whatever information you are having within the case study, first of all, you need to bring the financial statement perspective of that thing in your mind. Like, for example, the damage inventory. Now, we know that the damage inventory, the NRV of the damage inventory probably will be lower than the cost. And according to IS2, inventory should be recorded at lower of cost NRV. So first of all, you need to bring the accounting perspective of that particular thing into your mind. The next step is the risk, and risk will always be opposite. For example, inventory should be recorded at lower of cost or NRV. The NRV of the damage inventory may be lower than cost. There is a risk that the damage inventory is still recorded at cost rather than NRV. Now the impact resulting in the overstatement of assets and profits. So whenever you will be having an audit risk question in the exam, you start with the financial statement thing in your mind. The risk will be opposite. Now there are so many examples right in front of you. We are not discussing the response right now because we first need to understand the audit risk thing. The next stage will be understanding the responses. So we are doing only two columns first, the case study line, which is part of your exam question. So what I have done is exactly picked out these lines from your exam questions. And then in the next column, which is the audit risk, is how you're going to write the audit risk thing within the exam. So the first thing is the company has invested significantly in production process at a factory. This resulted in expenditure on updating, repairing, and replacing a significant amount of machinery used in the production process. Now we know the machinery used in the production process is the property, plant, and equipment because these are the assets for the business use. Now they're spending an amount on updating. We know this is the capital expenditure. Repairing, we know this is the revenue expenditure. And then again, replacing, again, the capital expenditure. So they're spending an amount which is a mix of the capital and revenue expenditure. And according to the standard, the capital expenditure should be capitalized, the revenue expenditure should be expensed out. Now, this is the financial statement perspective, the accounting treatment perspective, the accounting of that particular thing which is being mentioned in the case study. That revenue expenditure is expensed out, the capital expenditure is capitalized. This is the first thing that should come to your mind. The risk is opposite. There is a risk that the expenses may be misclassified. Now, the expenses may be misclassified as revenue expenditure may be capitalized or capital expenditure may be expensed out, resulting in the under or overstatement of the assets and profits. So the first step is to bring the financial statement perspective, the accounting treatment in your mind, and then the risk is the opposite. Then you need to tell the impact on the financial statement as well. For example, if the expenses are misclassified, the assets and profits may be under or overstated. Now, the second thing, disposal of the non-current asset by the company. If that is written in the exam, we know that the asset should be removed from the asset register and gain and loss on disposal should be recorded in the profit or loss. There is a risk that asset is still part of the asset register and incorrect gain and loss may be recorded within the profit or loss, resulting in the overstatement of assets and profits. Then the revaluation of the non-current asset by the company, it should be performed according to IAS 16. If that is not the case, the assets may be incorrectly valued. And I told you in the last lecture that there are so many risks related to revaluation you can write, but we can stick to the generic one. Like for example, we can also write, there's a risk that the depreciation may not be charged on the revalued amount, resulting in the understatement of expenses and overstatement of profits. There is a risk that the gain or loss on the revaluation may be recorded in the profit or loss rather than OCI, resulting in the misclassification of the gains and losses. So there are so many things we can write pertaining to the revaluation, but we will stick to the generic one. Then we have the unused property, plant, and equipment. Now, this is something related to F7. You already know that. And even this is part of the F3 impairment thing that is being just discussed over there. But in F7, we have a complete standard related to that. That we know that assets should be recorded at lower of its carrying amount and the recoverable value. Now, the carrying amount is a book value. Recoverable amount is higher of its value in use in the fair value less cost to sell. So if the asset is being redundant, it's not in use, there's no usage of that asset. That means it is an indicator that impairment review should be conducted. Maybe the recoverable value is lower than the carrying amount and asset is probably impaired. If the impairment is not being charged, then assets may be overstated. So unused property, plant, and equipment is relevant or related to the impairment testing. That impairment should be conducted. Similarly, we have the assets life revised impacting reduced depreciation. Now, we know that the change in the life, the change in the residual values, the change in the depreciation methods is the changes in accounting estimate. The IAS 16 suggests that, okay, these useful lives, the scrap values, the depreciation method should be reviewed annually, and they can be revised if there is a genuine change. So asset life, if the directors are revising them, okay, if there's a genuine change, they can do that. But there's a risk that they are doing it to manipulate the profits and the assets rather than a genuine change. For example, they have taken the useful life earlier 5 years, and now they're shifting it to, for example, 8 or 10 years. More life means less depreciation charge, more carrying value. So if there is a genuine change, standard allows it, but there is a risk that this has been done, or in fact, there's a risk that this may be done in order to achieve some profit targets, in order to manipulate the profits. So in that case, assets and profits may be overstated. Then we have a new accounting general ledger, a new accounting software has been introduced with the old and new system being run in parallel and even not being run in parallel. Like they're shifting the records from the old system to the new system, old software to the new software. So new accounting general ledger system means the new accounting software. So there is a risk that the opening balance is being misstated and the loss of data if they are not transferred correctly. Now, because they need to close the balances from the old system, they need to transfer it correctly to the new system. So there's a risk that those transfer thing may not be done correctly, and if that is not done correctly, then the balance may be misstated. Remember, in audit risk, what we are supposed to do is we are going to relate it with the financial statement. For example, if we say there is a risk that the data may be lost, and the management may have the problems related to the data afterwards. Now, this is the business risk. You do not have to be worried about that they will be having the trouble, they will be having the problems. What you're supposed to do is link that thing with the case, with link that with the financial statement. If the data is being lost, then the financial statement may not be having the correct data in it. If the data is not correctly transferred, then the financial statement will be having a misstated data. This is your concern being an auditor. So remember that whenever you're writing a risk, it should be related to the financial statement. Otherwise, that will become a business risk. Like for example, over here, uh, unused property, plant and equipment. Now they're not using the property, plant and equipment. This will affect their production and this will affect the scrap values of the asset. This is the business risk. You're not supposed to be worried about their production has decreased, their efficiency has decreased. You are supposed to relate it with the financial statement. If they're not using the property, plant and equipment, that is an indicator of the impairment, and impairment review should be conducted. If impairment is not recorded, then assets may be overstated. So, for example, disposal of the non-current asset by the company. If some students write this thing that the disposal may be done lower than the carrying value, resulting in the loss, this is a business risk. You should be concerned regarding the recording of that particular thing within the financial statement, that if they've disposed the asset, it should be removed from the asset register. The gain and loss should be recorded in the profit and loss. So anything which you are thinking like a businessman related to the business is a business risk, and you won't get any marks related to that. Okay, then we have the website has encountered difficulties with recording the sales. So again, like for example, if you write website has encountered difficulties recording the sales, some customers may not be able to place the orders. This will lead to the loss of sales. Now this is a business risk. You won't get any marks related to that, because in the audit risk you have to relate with the financial statement. So website has encountered difficulties. So this could lead to the errors in relation to the completeness of income. Maybe the revenue is not recorded within the profit or loss statement of profit or loss. This is the audit risk. Maybe the incorrect revenue is recorded in the statement of profit or loss due to the problem the website is having. This is the audit risk. But for example, if you're going other way around, like for example, this could lead to the loss of sales, the customer may be dissatisfied. This is not what you're required to write over here, because that is a business risk. You're supposed to relate it with the financial statement. Then we're having decreasing, releasing allowance for receivables. Now decreasing means when they're decreasing the allowance for receivable. For example, earlier it was 2%, now they're decreasing it to 0.5%. Releasing means they are eliminating the allowance altogether. Receivables are struggling to pay. They have extended the credit limit of the customers. Receivables days have increased. All of them gives the same meaning, that the allowance for receivables should be recorded. If they are decreasing the allowance, releasing the allowance without a genuine change, then the receivables may be overvalued. Now, you can write it this thing in a different way, like allowance. For example, if in the exam it is written receivables are struggling to pay, then you're going to write allowance for receivables should be recorded against the struggling receivables. If the allowance is not recorded, receivables may be overstated. Now you can write that thing in this way as well. Receivable allowance should be recorded. Profits and assets may be overstated if they are not provided against. If they are not provided against means the same thing, that the allowance is not recorded. So you can write the same thing in different ways. Refurbishment program. So again, when the entity is doing the refurbishment, it involves repairs, replacements, upgradations. So it's again a mix of the capital and revenue expenditure. So revenue expenditure should be expensed out, capital expenditure should be capitalized. There's a risk that the revenue and the repairs and the maintenance thing may be capitalized, resulting in the overstatement of the expenses and profits. So development expenditure incurred Development is going on again. It is related to IS 38. Research should be expensed out. Development should be capitalized. There's a risk that research cost may be capitalized or development cost being capitalized even if the criteria is not met, resulting in the overstatement of profits and assets. Okay, then we have the damage and obsolete inventory or the slow moving inventory. Again, when you're having a slow moving inventory, again, it should be recorded at lower of cost NRV, because damage and slow moving inventory, it should be provided against. It should be recorded at lower of cost NRV. If the inventory is not recorded at lower of cost NRV, inventory may be overstated. Then this is one of the most important point that you almost see this in every audit risk question. Inventory count at many warehouses of the company. You will see this thing in many questions that has come up till now in the exam. So what is that basically? The management is having multiple warehouses, multiple stores in which the auditor is supposed to count the inventory, but due to the lack of time, due to the lack of sufficient staff, the lack of team members, the auditor is not able to attend all the inventory counts. So where the auditor is not going to attend the physical inventory count, obviously they need to gather the evidence through other sources. So it is unlikely that the auditor will be able to attend all the inventory counts, and therefore they need to ensure that they obtain sufficient evidence over the inventory controls, and completeness of inventory may be at risk related to the warehouses which are not visited. So there is a risk regarding the completeness and existence of inventory related to the warehouses which are not being visited by the auditor. Then we have the standard costing for inventory valuation, like we have the FIFO, first in, first out, like we have the weighted average. So we have the standard costing thing as well. It is allowed by the IS2 as a valuation method, as long as if the standard cost is approximately equals to the actual cost. Like there is no significant variance between the standard and the actual. So there is a risk that the standard cost may be outdated, which leads to the under or overvaluation of the inventory. Then method of inventory valuation, whatever inventory valuation method is being chosen, it should not breach the basic principle of IS2, which is recording the inventory at lower of cost or NRV. Then we have the significant levels of the work in progress. Now, when you talk about the inventory, it involves the raw material, it involves the work in progress, it involves the finished goods. Now, the raw material and finished goods are easy to count because raw material is again a raw thing right in front of you. A finished good is a finished product right in front of you. But when we talk about the work in progress, is basically something in the machine, something is in progress. Now, obviously, it is possible that the auditor is not sufficiently qualified to value the work in progress. For example, you go to the car manufacturing industry and the car is at different stage of the production. Now, audit team may not be qualified to value the work in progress. Similarly, it may be something related to the minerals, something like that, crude oil, which is at a different stage of the extraction. The audit team may not be sufficiently qualified to value the work in progress, and as a result, inventory may be under or overstated. Like we are not valuing the basically inventory, the valuation is done by the management itself. What we are doing is we are checking the valuation ourselves, that whatever the figure management has recorded within the financial statement is basically appropriate or not. So part of our stock count is counting the work in progress as well. So if we are not counting the stock appropriately due to the insufficient knowledge and the skills we are lacking, then inventory may be under overvalued because we will be accepting the figures done by the management. So there's a risk that due to the nature of the production process, the audit team may not be sufficiently qualified to assess the quantity and the value of the work in progress related to the misstated work in progress. That whatever the management will be telling us, we will be accepting their figures because we are not sufficiently qualified to deal with it. Then we have the selling inventory below cost or substantially low price. So if they're selling the inventory at below cost or substantially low price, remember they should record then that inventory at lower of cost or NRV. So there is a risk that they are selling it below cost, but they have recorded that thing at cost, resulting in the overstatement of inventory. Then we have inventory in transit. So inventory, when it is recorded, when it is physically received. The cutoff thing means that inventory should be recorded in the correct period. Inventory and even the corresponding payable should be recorded in the correct period. So there is a risk that the inventory is still in transit and they have recorded it, resulting in the overstatement of inventory and liabilities. Then we have removing or reducing inventory provision. Why we will be having the inventory provision? This is just like the receivables. Like whenever we having a doubt that some of the receivables may not be recovered, we create an allowance for it. Similar is the case with the inventory. When we know that there may be some inventory which cannot be sold, then the provision for inventory is recorded, which means basically we in advance we record that thing as an expense. We book that thing as an expense. So if they are removing or reducing the inventory provision, then they're having an assumption that all the inventory may be sold. Then if their assumption is not appropriate, then inventory is overstated. Wrong product sent to the customer and customer is claiming damages is basically uh, when the customer is claiming damages and they have sued you, there's a litigation. Then if the outflow is probable, then what should be done is the provision should be recorded. And when they have returned you the goods, this is the sales return. Sales return should be recorded. If the sales return are not recognized, then revenue and receivable is overstated. Customer is claiming warranties. Now, outflow is probable. The provision for warranty should be recorded. If the provision is not recorded, expenses and liabilities may be understated. The management having significant annual bonus based on the year-end assets, then that means in order to get the more bonus, management may try to manipulate the assets and they may have done the creative accounting. Financial statement as a result may be misstated. Financial controller left the company. Now, for example, again, if you're saying the financial controller left the company, there will be a burden on the junior staff. The junior staff may feel indebted, things like that. Then this is the business risk. So basically, what you're supposed to write that the financial controller left the company, uh, and if there is no finance director yet, financial controller yet, the current staff may not be sufficiently experienced to deal with the financial reporting, and as a result, financial statements may be misstated. Like the financial controller is a senior person. Now, if the burden of the financial control is transferred to the subordinates, they may not be sufficiently qualified to deal with the financial reporting, and they're just doing the financial statements in the way whatever they know. So there may be misstatements within the financial statements regarding that. So this is the audit risk. You need to relate it with the financial statements. The company has taken the loan from the bank. The loan is a financial liability which should be split between current and non-current. If the split is not done, then the liability will be misclassified. There are covenants. Covenants means conditions, is basically when we have the loans on the floating charges. This is what you have studied in your F4 exam, floating charges. So if there's a floating charge thing and the bank has attached the covenants attached to the loan, particularly related to the minimum level of assets, minimum level of profits, for example, then in order to maintain the covenants, the management may try to manipulate the assets. So this is an audit risk because obviously when if you're not meeting the covenants, the bank will say, okay, you need to return the loans. So in order to meet the covenants, what they can do is they manipulate the financial statements. The audit firm asked to report earlier than planned. Now, obviously, this will lead to the increased detection risk that the auditor may not be able to detect the material misstatement if they are not spending appropriate time on the audit client. So there may be some errors and omissions which may remain undetected. Cash flow problems and no financing available or applied for loan but not yet received. Remember one thing that again, if you're relating it with the business, that they may not perform the business properly, they may not have the cash to support their operating cycles. This is the business risk. If they have not received the loans, or they are having the cash flow problems, or their current and quick ratios are being affected, they are having the liquidity issues, this result in the going concern difficulties. Now, how the going concern is an audit risk, because we have studied this thing in F7 exam, that if the entity is not a going concern, then the financial statement should be prepared on the breakup basis. Now, breakup basis means there will be no accruals, no prepayments, only realizable amounts will be there. So how the going concern is an audit risk, because if they're not a going concern, they should be prepared the financial state should be preparing the financial statements on breakup basis. So there is a risk that they are not a going concern, but they have still prepared the financial statements on the going concern basis. They are making the large workforce redundant. Now, obviously, redundancy payments should be made to the employees, which is an outflow probable. Provision should be recorded. If the provision is not recorded, liabilities and expenses are understated. Management is pressurized due to the previous year poor results. So in order to deal with this situation, they may try to manipulate the profits. They may try to do the creative accounting, which may lead to the misstated financial statements. Growth of revenue is not in line with the cost of sales. Now, obviously, these are related. When sale is increasing, the cost of sales should increase as well. When the loans are increasing, the finance cost should increase as well. When the property, plant, and equipment are increasing, then the depreciation expense should be increased as well. If they are not increasing in line with their relevant thing, then that means they may have either uh, overstated the sales, understated the depreciation charge, understated the finance cost, like that. The current and quick ratio is again related to going concern difficulties. And then we have last but not least, because there's other so many risks which you will be facing within your exam question. I'll give you 4 to 5 more examples of it, which is not in this table. Now, new audit client is, there are two risks related to that. The first, you may not have the appropriate understanding of the audit client, and as a result, there may be some errors and omissions which remain undetected. The second thing is that their closing balances, which are the opening balances of this year, may not be audited or audited by another firm, which may have the material misstatements in it. Remember one thing, there can be anything within the case study in which you are supposed to identify the audit risk. So you just need to relate it with the financial statement. For example, they say that the bank reconciliation is not performed. Now, if the bank reconciliation is not performed, then there may be unreconciled differences. And if there are unreconciled differences, then the cash at bank balance in the current asset may not be correct. It may be misstated. Now, this is simply an audit risk. For example, they say the vendor reconciliation is not performed. Now, what is vendor reconciliation? Vendor or supplier reconciliation is when you reconcile your ledger with the supplier ledger so that the same balances are being recorded. So if they are not reconciling it, then that means there may be understatement of the liabilities. Then, for example, there may be that they're issuing the equity shares. So share should be split between the share capital and share premium. If the split is not done, equity may be misclassified. For example, they say the company is issuing the redeemable preference shares. Now, this is should be recorded as debt. There's a risk that it may be recorded as equity. So there can be anything within the question. So you just need to deal with it by relating it with the financial statement. So these are the so many things I have shown you over here. Whenever you will be having a question, probably all the things will be from this table. But for example, even if you're having new points within the question, you need to make sure you are relating it with the case study. So this is just the risk we have discussed. The next step would be the responses. Uh, the responses are very important because this audit risk carry 1 mark, and then we have 1 mark for the response. So although I have written that thing within the table, but in the next lecture, we will be discussing how to draft the responses. What is the auditor response to each assessed risk?